Hey everyone, in this particular video we are going to discuss about the RBI Circular December 2025. So this is going to be part 3 and this is the final part, right? We have already released video 1 and video 2 and this is going to be the third video related to the December 2025 month. So don't take too much pressure related to RBI Circular specifically from the month of December. Why? Not so many new circulars are there, rather these circulars are amendments rather than the full-fledged circulars, right? So let's start with the first one, which is related to the Reserve Bank of India non-operative financial holding company, right? Non-operative financial holding company. So do you guys understand the concept of NOFHC? The whole idea is if you are a banking company, you can undertake so many other operations as well, like insurance, like advisory services related to mutual funds and so on, right? But we need a single entity who is controlling each and every other entity. Let me just give you a quick example. Say for example, Bandhan Bank, right? Now there are so many entities, Bandhan Bank, Bandhan Asset Management Company, Bandhan Life, and there are some other categories also. So we want the Bandhan Bank to be completely distinct from the conflict of interest, right? There should not be any kind of conflict of interest. So that's why we do have a NOFHC, non-operating financial holding company. In this case, we are having Bandhan Financial Holding Company, and this financial holding company is having the investments in Bandhan Bank, Bandhan AMC, Bandhan Life and so on, right? So I can say that the entity should be distinct. It should not be like the bank is doing all the types of business. No, if you want to do some other business, then you need to form subsidiaries and associate companies and so on. And all the shareholding, right? All the shareholding, the investments will be made by a single company, which is non-operating financial holding company. That's why we call it as non-operating. So this company is not operating anything, rather it is just a holding company. Right? Rather, it's just a holding company. What do you mean by a holding company? A holding company is holding securities of subsidiary company, associate company or joint venture company, right? Let me just quickly share with you the understanding of the concept related to holding, subsidiary, associate and joint venture. So let's suppose P Limited is a holding company. P Limited is a holding company. This is 0%, this is 100%. This is 20% and here we have 50%. Okay. So if I am holding shares, let's suppose of ABC Limited, I am holding shares of ABC Limited more than 20% but up to 50%, more than 20% but up to 50%. So this will be my associate company. This is going to be my associate company. The moment I start holding more than 50%, let's suppose B Limited, in B Limited I am holding more than 50%, this will become my subsidiary. This will become my subsidiary. In both the cases, P Limited is the holding company, but ABC Limited is the associate company of P Limited and B Limited is the subsidiary company of P Limited, right? If I start owning 100% of the equity share capital of a company, then that will be called as a wholly owned subsidiary. So this is the concept of holding, associate and subsidiary, and joint venture is nothing. For temporary basis, I have entered into a partnership with some entity, just like Reliance has entered into a partnership with Alliance Group for the reinsurance business in India, right? So this is the concept of holding subsidiary. Now if we talk about the NOFHC company, non-operative financial holding company, it's nothing but a holding company and it is not operating any business. Okay, it's just making investments, it's just holding the shares of the bank and the other regulated financial service entity, right? Now why RBI wants you to create a non-operative financial holding company? The idea is same, to create boundaries, right? To ring fence the bank from the risk of the other groups. Now RBI don't want that the bank to have all the kind of risk emanating from AMC or from the life insurance business or from any other business. That's why RBI is of the opinion that let's separate the banking business from rest of the business, right? So here they have clearly written that all the activities permitted to the bank under section 6 subsection 1 of the Banking Regulation Act shall be carried out from the bank, So specialized activities like mutual funds, insurance business, pension funds, investment advisory and anything like that shall be carried out only through the help of subsidiary, associate, joint venture, right? So bank cannot directly enter into such a kind of business. Rather, the bank has to create different subsidiary companies, associate company or joint venture for doing that, right? So that's why we need a group company, a holding company to hold the shares of each and every other company. If I talk about Bandhan Bank, then Bandhan Bank is a separate entity. Then Asset Management Company, which is the mutual fund arm of Bandhan Bank, is a separate entity from its bank. Bandhan Life, which is the life insurer, is a separate entity, and as a whole this NOFHC, non-operating financial holding company, is holding all the shares of each and every bank and other entities. Why? Because it operates as a single group, Bandhan, right? It operates as a single unit. So the applicability of these guidelines, it is applicable to every NOFHC in India, right? And obviously if you are a NOFHC, you must be registered with RBI as a NBFC, right? You can't enter into a banking business. Rather, you have to form your subsidiaries, associate for doing the banking business, right? The person or group having effective control will be definitely called as promoter. So if you are holding significant control of bank or the non-operating financial holding company, then you will be called as promoter, and your relatives, the companies in which you have significant stake or your associate related parties will be called as promoter group, right? Will be called as promoter group. Acha, financial institutions or banks or FPIs or mutual funds are not promoters just for the sake that they are holding in excess of 10%, so we can't call them as promoter, right? It is an investment which is normal in nature, right? Not strategic in nature. Registration: if you are a non-operating financial holding company, you need to get yourself registered with RBI as a NBFC, and you need to make your application via Prava portal. And this NBFC, as we all know that the base layer, layer regulations are there, scale based regulations are there, which classifies the NBFC in different layers. So this will be always treated as base layer. Okay, please do remember this stuff, can be important for your examination, right? So the whole idea is creating a ring fencing, that means creating some boundaries. The NOFHC must hold the bank and rest of the regulatory financial entities. The whole idea is separating the commercial banking business with that of the other financial business, right? And there are certain criteria to maintain good amount of corporate governance also. Like if I talk about the board composition, at least 50% should be independent director, of this board of the non-operating financial holding company. Sir, what do you mean by independent director? You all know that what do you mean by directors? They are actually running the company on behalf of the owners, right? Directors. In directors, we have executive directors. We also do have non-executive directors. Now, what do you mean by executive directors? Who are actually participating in day-to-day activities of the business. They are actively participating in day-to-day activities of the business. As non-executive director, you are not participating in day-to-day functions of the business, right? So in non-executive director, there are some directors which can be called as independent. Now, why do we call them independent directors? Because they are actually independent. They don't have any pecuniary relationship, right? They don't have any financial relationship with the company, right? So a particular section is there in the Companies Act, in the Banking Regulation Act, which deals with the independent director classification, like who are the person who are qualified to become independent director. So in one liner, I can say they don't have any kind of financial interest in the company. That's why we call them as independent. They are more related to the leading regulatory committees, like, we do have so many different committees like audit committee or so on. So here also the non-operating financial holding company का board should have at least 50% as independent director who are completely independent and they do have the requisite expertise as well, right? The ownership and management must be separate here. That's what the main idea here is, right? That's what the main idea here is. Now, the most important thing from this particular circular is a non-permitted activity of NOFHC. If you are a non-operating financial holding company, then you cannot involve in these kind of activities. Like you can't do the advisory business. You can't hold physical assets of the group, right? You can't set up a new financial entity for 3 years after the bank starts. So these are some of the restrictions on NOFHC. And what must be done by the bank via subsidiaries? So here, the bank, what the bank has to do, the activities are allowed in the Banking Regulation Act. Definitely you have to do that. Any other specialized activity, let's suppose you want to enter into the business of mutual fund, like HDFC Bank is a bank, but HDFC AMC, HDFC mutual fund company is also there. ICICI Bank is also a bank, but ICICI Prudential Mutual Fund Company is separate. So if you want to enter into mutual fund business, insurance, pension, investment advisory, portfolio management or broking business, then you need to create different subsidiaries, joint ventures or associate company. Only then you can do. As a bank you cannot do that, right? However, no prior approval is needed. Only intimation is required within 15 days. Now RBI is going to definitely supervise the bank, the non-operating financial holding company and all the rest of the group entities on a consolidated basis. So this is the amended provision. The clear principle states that all the normal banking activity from the bank itself will be conducted, and if you want to undertake any specialized financial service activity, maybe it mutual fund, maybe it is insurance, separate it from the bank. Next is the update rather than a circular. So in RBI circular series, what we do is we cover all the circulars plus we cover all the RBI related news also, which is there on the website, right? So this will definitely help you to prepare for RBI Grade B examination or any other examination where the circulars are important, where the RBI circulars are important, right? So काफी बार query आती है sir whether RBI circulars are important for this exam also, is this video important for that exam also? So if RBI circular is there in your course, then definitely this video is going to be important. RBI announces measures to manage liquidity condition. OMO purchases we have already discussed in second part of the video, open market operations, right? Second one is USD INR buy sell swap, right? So in this particular video, we are going to discuss about the USD INR buy sell swap. How RBI is actually injecting the liquidity through the long term USD INR buy sell swap. The very first thing that you need to notice, this is a long term. So I can say that this is going to inject durable liquidity. This is going to inject durable liquidity, right? So let me just give you a quick example how it works. Reserve Bank of India and banks. We do have banking entities. So banks are holding foreign currencies also like dollars. RBI is having adequate INR. So why not RBI inject liquidity in the system in the form of rupee, that is INR. In return, bank will pay RBI in the form of US dollars, right? So this is the transaction number 1, which we call it as the near leg or the spot leg, right? Near leg or the spot leg. Now this is a swap. So the transaction will reverse. Whatever transaction you are doing will definitely reverse, because that's what happens in case of swap agreements, right? What will be the second transaction, which is also called as the far leg? In the second transaction, we will reverse it as it is. We will reverse the first transaction. So now the banks have given the US dollars and the RBI actually injected the INR liquidity. Now what bank will be doing is, the bank will be again paying Reserve Bank of India in the form of INR, and the RBI will be again swapping the dollars, right, in return of the INR. So this is called as the far leg. Sir, why you are doing this? What is the sense of doing this kind of transaction? First the RBI is actually injecting INR, then after some years the RBI is again taking back the INR from the banks. It works very well. Why? Because our economy works in cycle. Sometimes there is adequate liquidity, sometimes we don't have liquidity, right? That's why people start getting confused when I read the finance current affairs or when they read the newspapers. Sir, कभी तो आप कह रहे हो कि RBI is injecting liquidity in the system. Sometimes you are saying that RBI is extracting, or I can say absorbing the excess liquidity from the system. So why is it so? Because our economy works in cycles. Sometimes there is a need of liquidity and sometimes there is an excess of liquidity, right? So as of now there is a need of liquidity, that's why RBI is doing this kind of swap, right? Eventually when there is a adequate amount of liquidity in the system, then this transaction will be reversed, right? So this is the concept of USD INR buy sell swap. I have already released a detailed video related to this concept also. Next is your monetary policy committee meeting, which was there in December 2025. So we all know that RBI has again reduced the repo rate by 25 basis point, and now the current repo rate is 5.25%, right? It is 5.25% as of now. So guys, 25 basis points means 0.25%, okay? 100 BPS means 1%. So 25 basis points will be 0.25%, right? The financial year GDP growth rate as per the MPC meeting is upgraded now to 7.3%, and the CPI forecast is now lowered to 2%. This is for the financial year 2026, right? And we have already discussed that the RBI has injected the liquidity into the system by using OMO and the FX swap, right? There's GDP and inflation figures we have already covered, and this is a step towards injecting the durable liquidity into the system, right? So similarly, amendments were made on the RBI website. So in the circular also you can see adjustment in the liquidity facility, right? Change in the rates from 5.5% to 5.25%. Similarly, the standing liquidity facility for the primary dealer and the penal interest on the shortfall of CRR and SLR requirement, that means the bank rate is being imposed. Everything is being changed on the RBI via a circular, right? So after every MPC meeting, they post at least 3-4 circulars related to the changes in the following rates, right? Next one is related to the Urban Cooperative Bank Authorization, okay? UCB's bank authorization direction. So a new direction is there now. Earlier the direction was consolidated in November 2025, but RBI as of now has replaced the earlier direction with that of the new one on 4th of December 2025, right? So replacing a direction doesn't mean that the earlier direction will be completely out of the market. No, all the important provisions, all the authorization given by the old circular will still be there, okay? Will still be there. So this is just a quick update on what bank authorization is all about. So earlier we have seen so many problems in the urban cooperative banks related to too many branches. Without the financial strength, banks are opening too many branches, right? Branches were opened to benefit the directors or the relative of the directors, or so many biasness and I can say poor planning was there in the urban cooperative banks. Now this circular is there to control the expansion of the UCBs, right, and track the usage of the fund. Now expansion is not always good, but maybe the expansion is not required and still we are expanding, then that can definitely pose significant financial risk also on the bank. So now a UCB can open definitely branches, ATMs only if it is financially healthy, right? That's what is being imposed in the new circular. So minimum condition, bank needs to have some extra capital buffer, right? Bad loans, how you have low bad loans, you need to have some low bad loans. You need to be profitable for the last at least 2 years, and you should not have defaulted in at least the CRR and SLR requirement. So there are so many provisions for getting the branch authorization related to the urban cooperative banks, right? So many controls are now imposed. You should be only financially strong bank. Then there should be some headroom, like each bank needs to at least contribute 2 crore of the net worth capacity. You need to have at least 2 crore net worth capacity. Then board accountability should be there. right? Annual review of that accountability should be there. The director interest should be disclosed in the reports on a regular basis, right? In every branch, ATM, office, shift or closure must be reported within 7 days on the RBI CISBI portal, right? So there is a portal for that. There will be a digital tracking related to each and everything. And similarly, for rural cooperative banks also a same direction is applicable. The name will be Urban Cooperative Bank and Rural Cooperative Bank, bank authorization directions, right? Now here in this list released on the 11th of December, we can see so many circulars, and here most of them are related to credit risk management, right? So this particular portion, I will say 1, 2, 3, 4, 5, 6, 7. 7 circulars are directly related to the credit risk management. Credit risk management. The credit you have given as a bank, you have to give credit. So the credit you have given to the borrowers, how you are going to manage the risk, right? How you are going to manage the risk emanating out of the credit, right? So this is released for commercial banks, small finance bank, regional rural banks, UCBs, RCBs and other categories of the banks also. So we have to just cover the crux of this one circular, and you guys can definitely check out the other circulars also. The requirement is broadly the same only, right? So let's talk about the RBI Commercial Banks Credit Risk Management Amendment Direction 2025. So these are the amendments. We were already having some circulars related to the credit risk management, and these are the amendments here, right? So let's get the discussion started, guys. This all has been done to strengthen the credit discipline. There should be discipline when you are giving credit, and the borrower should also be quite disciplined, right? For preventing the fund diversion and improving the monitoring of the borrower transaction. So what happens nowadays is, let's suppose bank is lending money to the borrower. Now the borrower has obtained the loan for business purpose, and maybe they are using for some private purpose, right? Maybe they are using for some private purpose. Let's suppose you are using the current account, right? You are obtaining loans, right? You are obtaining credit from bank, and you are using that fund for your personal use. Maybe you are investing in stock market, or maybe you are buying some personal assets with that money, right? The loan was for business purpose and you diverted that into the personal purpose. So a lot of things are there related to risk that requires management. That's why we have credit risk management, right? That's why we do have credit risk management. So all these accounts can be used for the transaction. Why RBI is concerned? So these accounts like current account, cash credit, CC account or OD account, all these accounts can be used for transactions, and when multiple banks allow unrestricted current or OD account. So I can say a plain borrower is having so many OD account and current account in it in different banks. The funds may be diverted. The lenders also lose visibility over the cash flow, where the cash flow is actually going for the legitimate purpose or not, right? Credit monitoring also becomes weak if you are offering so many current accounts, CC accounts and OD accounts. So the RBI has now introduced the account level discipline linked to the exposure size, So what are CC accounts, guys? CC means cash credit. It's nothing but a working capital kind of a facility. You are getting loan for the working capital purpose. Let's suppose I am pen manufacturer. So I have to source plastic, I have to source ink, I have to hire labor for creating this pen, for manufacturing this pen for me. All these things will take a good amount of expenses I have to do, and my funds will also be blocked, right? And that's what we call working capital, the funds that are blocked in my business, right? We call that as my working capital. So the whole idea of this particular account is to offer you working capital facility, right? To offer you loan for the working capital requirement purpose, right? You'll be selling on credit also, again your money is blocked. So in business, a lot of money is required for working capital purpose, and this account is this loan account is there to take care of the needs related to working capital of a businessman. Now RBI opinion on the CC account is there is no restriction on the maintaining of CC accounts with different banks, right? No restriction is there as of now. Why? Because CC account is directly related to your business operation and the asset monitoring. So you are obtaining loan for stock receivables and so on, and that's totally fine. That's totally fine. RBI don't want to put any kind of restriction. But when I talk about current account and overdraft account, there are now certain restrictions that RBI has imposed on the regulated entities, right? So the exposure below 10 crore rupee, if aggregate exposure of the banking system is less than 10 crore, I can say any bank can open and maintain their current account or OD account without any restriction. If the exposure is below 10 crore, no worries at all. The aggregate exposure is less than 10 crore rupees in the banking system, then the bank may open and maintain current account or OD account without any restriction. No restriction will be there, right? But if there is an exposure of 10 crore or more, let's suppose there is a exposure of 10 crore or more. And what do we mean by exposure here, guys? Let's suppose I am a customer of bank. Right? So I have taken so many loans, or I can say I have so many accounts, which is HDFC Bank, with SBI Bank, with ICICI Bank and so on. I have taken so many loans. My total exposure here is less than 10 crore, right? So there is no restriction at all. Any bank can open and maintain current account or OD account without any restriction. I can open my current account or OD account with any bank because my total exposure, my total loans and advances, both fund based as well as non-fund based, are within the exposure limit of 10 crore rupee, right? But the moment the exposure is 10 crore or more than 10 crore, if the aggregate exposure of the borrower exceeds 10 crore rupees in the banking system, then strict rules will be there, right? A bank can definitely maintain current or OD account only if it has exposure of equal to 10% or more than 10% in the total banking exposure, or equal to 10% or more than 10% share in the total fund based exposure. I'll be definitely giving you example also. This circular is a bit difficult to digest, so no worries at all. If you are not able to understand it, I'll be giving you an example also, and after that example definitely you guys will be able to understand it, right? We just have to remember as of now the limit of 10 crore rupee. If your exposure is more than 10 crore rupee in the banking system, then definitely strict rules will be applicable regarding the opening of the current account and the OD account. The bank has to follow these kind of restrictions and rules, right? So let's talk about different cases. For example, there are 4 banks, right? There are 4 banks and these are the loans that I have taken from different banks. Now bank C, I can say that the bank C has only 5 crore rupees, right? The bank C has only 5 crore worth rupees loan, right? So I can say that the total exposure is 100 crore here of the borrower, 60 crore, 25 crore, 5 crore plus 10 crore. And out of that, bank C is having only 5 crore divided by 100 crore. That is just 5%. That is just 5%. In that case, bank C has only 5% of the exposure. So bank C cannot open the current account. Bank C cannot open the current account, but bank C can open a collection account. What is the meaning of collection account? You can definitely collect whatever income you are getting, right? You can definitely collect whatever income you are getting in that account. That is called as collection account. It is just for the inflow purpose. It is just for the inflow purpose. So let's read it again. You can definitely impose restrictions, but the bank should have the skin in the game. The bank should have the skin in the game. What do you mean by skin in the game? A bank shall maintain CD, current account or OD account only if it has greater than or equal to 10% of the share in the total banking exposure. What was the total banking exposure here? 100 crore. Out of that, every bank is having more than or equal to 10%, but only bank C is having 5 crore rupees, right? Only the bank C is having 5 crore rupee, which is equivalent to 5% only as of now in this particular case. So here, the bank cannot maintain the current account or OD account. The bank cannot maintain the current account or OD account because the bank is not having adequate skin in the game. So the limit starts at 10% or more than 10% only. So I can say here that case number 1, total loans from all the banks is below 10 crore rupee. In case, what if the borrower is having the total loans from all the regulated entities from all the bank below 10 crore rupee, then no restriction at all. The bank can definitely open the current account or OD account. Why? Because the condition 1 in itself is not satisfied. So I won't be checking the condition 2, right? The very first thing is the borrower should have at least an exposure of 10 crore, then only you are qualified for this circular. So this becomes the most important limit for your examination. You just have to remember this particular limit, the condition 1, right, as of now. Now if I talk about the exposure limits, if you have the borrower is having total loans from all the bank is 10 crore or more than 10 crore, then rules will be applicable, strict rules will be applicable, right? For borrower with 10 crore or more exposure, the banks which are seriously exposed to the borrower, I am talking about bank A, I am talking about bank B, I am talking about bank D. These are the seriously exposed banks. Why? Because they do have skin in the game, 10% or more with that of the, as compared to the total amount of borrowing, right? They have skin in the game. So again, these exposure rules will be applicable here, right? And the meaning of significant exposure means at least 10% of the total loan, at least 10% of the total loan. So here we can see bank A, B and D are having 10% or more than 10% of the total loan amount here, right? So here we can see that in case of the customer whose exposure is crossing 10 crore or more, then in that case the banks can maintain definitely the current account or OD account as per the specific needs of the customer, but subject to these two conditions. You should be having skin in the game. You can open current account or OD account, but you should be having skin in the game. If you don't have skin in the game, then you can't open current account or OD account, but you can definitely go for the collection account. You can definitely go for the collection account, right? So what if only one bank has the exposure? What if only one bank has the exposure covered by this proviso? In case no bank within the banking system meets the above requirement, what if no bank is having 10% or greater than 10% requirement, then what will happen? Will I not be able to open a current account or a OD account in any of the bank because any bank is not having 10% of the share, right? Then two banks from the banking system having the largest exposure. So it doesn't matter, whatever the banks who are having the largest exposure to the borrower may maintain my current account or OD account. They will be maintaining my current account or OD account. If no one is having 10% or more than 10% skin in the game, no worries at all. The largest two banks can definitely open my current account or OD account, right? In case only one bank within the banking system is having the exposure, let's suppose only bank A is having that much exposure, right? So will I be having no other option? I have to go to a bank A only. Is it a compulsion? No. RBI has relaxed the requirement. One more bank of the customer's choice, as per my own choice, I can wish to open a current account or CD account. I can definitely open that within the banking system. May maintain a current account subject to furnishing of the no objection certificate from the bank that has the exposure to the borrower, right? So I have to take the NOC from bank A if I want to open an account with bank D, right? Now this is the additional, I will say, bank permission that RBI has given. If your exposure is, or if the exposure of the bank, the skin in the game of the bank is only of bank A, so I can say I can also open a bank account with bank C, but bank C has to take NOC from bank A. But bank C has to take NOC from bank A, right? So these are some of the requirements. I will say that this particular limit you have to remember, and this particular limit, right? These two limits can be the most important limits for you guys for the examination perspective. Rest, I will say, it's more related to the procedural part of the banking system, which you can also later on learn once you become the RBI Grade B officer. Not to go into too much detail of each and every circular, because most of the circulars, I can say, are rather process oriented, and this is the update from the credit risk management related to each and every regulated entity here, right? Next one is related to the cash reserve ratio and liquidity, statutory liquidity ratio amendments. So this is nothing but the change in the definition of fortnight, okay? The definition of fortnight is now changed, and this can definitely be important for your examination. So let's read the new definition. The definition of fortnight has been amended from the period from Saturday to the second following Friday. both the days inclusive, to the period from the first day to the 15th day of the calendar month or the 16th day to the last day. So earlier we used to have the definition of period from Saturday to the next following Friday, But now what is the new definition? The period from the first day to the 15th day of the calendar month, or 16th day to the last day of each calendar month, right? So that's the new definition of fortnight, which you have to guys remember, right? So earlier it creates so many problems. Why? Because Friday and Saturday can definitely be different dates in every month. So that's why they have aligned it with exact dates rather than the days, right? So they have moved from the days to the date now, right? Exact date. So that's why RBI has amended the provision and it provides a smooth transition as of now without changing the CRR or SLR rates, right? So CRR and SLR, statutory liquidity ratio, cash reserve ratio. For example, if you are a bank, you got some deposits. Now, in order to maintain adequate liquidity, let's suppose you got 100 rupees as deposit. So you need to maintain CRR with Reserve Bank of India, and you need to maintain SLR also with yourself, with the bank itself. So I can say you can't lend the whole 100 rupee whatever you got as deposit. Rather, you first have to reduce the CRR and SLR, right? And then only you can grant the loans and advances. CRR is kept with RBI and SLR is internally maintained by the bank in the form of approved securities, approved SLR securities, right? Both are serving the broadly same purpose only. So the maintenance of these ratios are on a fortnight basis. You need to comply with some of the requirements of these ratio on a fortnight basis. That's why there is a change in the definition from Saturday to the second following Friday. Now the definition is the first day to the 15th day of each calendar month and 16th day to the last day of the each calendar month, and both the dates are now inclusive, right? So this is the change which I can say is now effective, right? So it is applicable to all the banks. That's why they have separately released the directions related to each and every bank. So nothing to worry guys by having a look at so many circulars. Most of the common provisions are only there. Then a formation of new district in the state of Gujarat. So a new district is formed in the Gujarat and we have to assign the lead bank responsibility as well. So the lead bank responsibility is now assigned to the Bank of Baroda, right? To the Bank of Baroda. Next one is related to continuous clearing and settlement on realization in the check truncation system phase 2. So we all know that we moved from the batch processing system to the continuous clearing system. I'm talking about the check truncation system, right? In banks we do have check truncation system. Earlier we used to have batch processing. Now we used to have continuous clearing and settlement, right? So we tried implementing the check truncation new system in the banking channel, and as of now RBI has advised that the implementation of phase 2, we implemented this in 2 phases. As of now the phase 2 is being postponed. It is being postponed till further notice, right? So the bank needs time to streamline their operation in accordance with this particular circular that we earlier discussed. The timing of the presentation session is modified to 10 AM to 3 PM and the timing of confirmation session is modified from 10 AM to 7 PM. So the presentation session timeline is now 9 AM to 3 PM, right? And the confirmation timeline will be 9 AM to 7 PM, right? So this is the change, and for those who are hearing it for the first time, I know that there are so many students who are not aware about this change. Just search this lecture on YouTube. This is regarding the check truncation system, RBI's check truncation system, right? Search it on the Olive Board YouTube channel or just write check truncation system RBI Olive Board on the YouTube. You will find my video. This is just 17 to 18 minute video, and all the concepts related to check truncation will be covered in this particular video. Why? Because this circular came back, I will say this is almost 4 to 5 months back circular, right? I have already covered in that respective month circular series. So please do watch this specific video for the exclusive understanding, and then you will be able to understand this particular news. It is just a quick update, right? Next one is related to the KYC amendment directions here in the different banks, right? Now the KYC which is already uploaded in the central KYC registry shall now be responsible. The REs that has last uploaded the KYC document, let's suppose there is one bank, a regulated entity, which has uploaded the KYC documents of a customer on the CKYC, right? There is a central KYC, so that we need to avoid the duplication, right? Shall be responsible for verifying the identity and the address of the customer. So the RE must have verified the address and identity of the customer. Now let's suppose if any other regulated entity is downloading the KYC from such a kind of CKYC, right, and relying on such record, then this central KYC should not be required to be re-verified or for the authentication purpose related to the customer identity and address, because it is already verified by the first regulated entity, So this is just a procedural update, I will say, right? And all the directions are related to this procedural update only, related to know your customer, right? If it is already verified by the first regulated entity, then you don't have to re-verify it. You can just download it and you can use it, right? Next was the international investment position published, India's IIP data September 2025, which is published by the Reserve Bank of India on the website on 31st of December 2025. So this is nothing but the data like how much non-residents are investing in India and how much Indians are investing in different foreign countries, right? So this is called as the international investment position. So the net claims of non-resident, if non-resident is claiming on us, that means they have invested more than what we did, right? So the net claims of the non-resident in India declined by 38.4 billion US dollar during the quarter 2 of financial year 2026, and the figure stood at 274.3 billion US dollars, right? This is the data ended September 2025. So I can say that this data will keep on changing. You have to remember the data which is published just before your examination and not all the data which is published from now onwards. So it's just an idea like how the data is being published every quarter, right? We also publish the ratio of India's international asset to that of the international liability. That means how much assets you are having internationally divided by how much liabilities you are having internationally. So this is 81.3%. That means if the liability is of 100 rupee, asset is just worth rupees 81.3, right? So the assets are lower than that of the liabilities is what I would like to teach you here, right? That's what the international asset divided by international ratio means, right? So this is the data which is being published related to India. Now you are having too much data in it. You don't have to remember each and everything. Just read the key features which are published related to the India's IIP data every quarterly, and as of now you don't have to remember this data, rather you just have to gain a quick understanding of what IIP is all about. So it is all about the net claims, how much we are investing out of India and how much they are investing, the non-residents are investing in India, right? This is the data. Now next is the circular related to commercial bank concentration risk management. Concentration risk management. What do you mean by concentration of risk? Concentration of risk means we don't have adequate diversification, right? When I am lending to one particular borrower only consistently, I can say there will be a concentration risk. All the funds are concentrated in just one entity. So it can create a risk. Why? Because if he or she defaults, then that can definitely impact my bank, right? So this is the risk of not diversifying your loans and advances, right? So many updates are there in it. I would like to just quickly teach you about the upgrades here. The objective is reducing the risk from excessive exposure to single borrower. If you have given a single borrower so many loans and advances, or a single group or a single sector, so many loans and advances, now this can create a good amount of risk, right? So concentration risk means it arises when the bank lends too much to one borrower. So I can say that my risk is concentrated in a particular borrower or in a particular group or maybe in just one sector, right? So if single borrower fails or the sector is not working, then there can be definitely big losses for the bank as well. Now there are certain changes in the large exposure framework. We call this as large exposure framework because we actually are taking a large exposure in some of the sector or the entity. Tier 1 capital. Tier 1 capital infused just after the balance sheet date. So I published my balance sheet here. Now I have infused some tier 1 capital here also. I have infused some tier 1 capital here also. But the earlier law prescribed that we have to take tier 1 capital as on the balance sheet date. Even if I am doing some transaction here, I could have considered all the tier 1 capital before this transaction, but the law restricted the wordings to only the balance sheet date. But now RBI is giving slightly more flexibility. Why? Because RBI has allowed you to include the tier 1 capital you have raised after the balance sheet date also, right? The current year profits to be included in the tier 1 capital again for the large exposure framework purpose. So definitely higher the tier 1 capital, better will be your loan giving ability, I will say, even in the large exposure framework. So higher the tier 1 capital, better will be your capability, and that's what RBI did. They increased your capability. Why? Because even if you have inserted some capital, you have raised some capital, tier 1 capital or your profits after the balance sheet date, everything will be now be included for the purpose of calculation purpose in the large exposure framework, right? Now here they have clearly stated that the overseas branches of banks are not treated as group entities for the intra-group exposure limit. So let's suppose a bank A is having some overseas units like bank B, bank C. So these are overseas units which are not in the country, which are situated outside India. So will they also be classified as the group entity, right, for the exposure limit purpose? No, they won't be classified because these are the overseas branches of a bank, right? However, any kind of proprietary derivative transaction with the overseas branches are included. Now, what do you mean by derivative transaction? We all know what derivatives are. We have studied multiple times in different lectures, and if not, then first you need to watch the lecture related to derivative, right? Then proprietary derivative transaction means you have taken derivative transaction for your own purpose. You are not selling a derivative transaction to someone, or you are not just a facilitator, but you are taking a proprietary derivative transaction for your own branch, right? Now, even if it is with the overseas branch, that transaction will also be included. Why? Because there is a good amount of risk in the proprietary derivative trade transaction, right? Similarly, if I talk about proprietary trading, what is the meaning of proprietary trading? Now, Zerodha, let's suppose, let me just quickly explain you the word proprietary. Zerodha is a broker. That means Zerodha is buying and selling securities on behalf of the clients. Right? Let's suppose Zerodha is having one more unit, a proprietary desk, a prop desk, which we also call it as prop desk. That means Zerodha has also invested its own money, let's suppose 10 crore in the prop desk. That means this unit is actually taking the trades, but for the behalf of Zerodha only, but for the internal purpose only, right? So they are a broker. They are definitely facilitating the transactions that clients are asking them to, right? At the same time, they have a self desk, or I can say proprietary desk only, where they themselves are doing the trading activity for their own purpose. So I can say that it is a prop desk. So that's what the meaning of proprietary derivative transaction is. The bank is entering the derivative transaction for their own purpose rather than the client's purpose, right? Now in the base circular, this is the amendment circular that we discussed. Only that will be relevant for your examination as of now, because the base circular is quite old, right? But still, let me just quickly discuss about the exposure limit as well. So in the large exposure framework chapter 3, there are certain exposure limits. Exposure limits for the foreign bank. For Indian branches of foreign global systematic important bank. If you are a GSIB, global systematically important bank, What are DSIBs, GSIBs? I have already discussed in the part 1 of the circular video, right? For the Indian branches of foreign global systematically important banks, let's suppose there is an Indian branch of the FGSIB, then the exposure will be limited to 20% of the eligible capital for the head office or other global systematically important bank, and for others it will be 25%. For the Indian branches of foreign GSIBs, for foreign non-GSIBs, the limit will be 25% and 20% respective. 20% for the head office and for the other global systematically important banks, and 20% for the GSIBs. Now, this is the core part of the older version of the circular. You don't have to study or spare too much time reading this particular thing. You just have to understand what is the amendment that I already told you, right? So these are the changes here, guys. These are the changes that you need to remember here. So which concludes our RBI circular December 2025. Now don't take too much stress about the circulars. All these are mostly amendment directions. So whatever things I taught you in this particular video will be definitely be important and enough for your exam perspective, because circulars are too detailed and you don't have to understand each and every part of the circular, because the end game is not to understand, have to be super strong in understanding the circulars, but the end game is to clear the examination. So क्या एग्जाम में आ सकता है, what things can come in the examination, I have already told you. And in circular there are rarely 20 to 30% things that can come in the examination. Rest remains the procedural part, right? So thank you so much, guys, for attending the lecture. I hope you enjoyed it, and this is the RBI Grade B complete course with books, so you can definitely prepare for the RBI Grade B examination. You can check out the course as well for your preparation. Thank you so much. Bye bye. Take care. See you soon in some other video.